I believe a strong probability of a reversal in gold and silver. As long as that conflict remains headline news, until that changes, we could see gold meander lower, silver go lower, and crude move higher. Silver, I believe, has room to go as low as the 200-day moving average. It's tested and found support at the 78 fib retracement. You have to take the truth. It's been bearish, and we have a bearish Domino right now. I haven't seen gold like this, but at 42.85, if it does come down and test the 200-day moving average, that's at 4,090.
Bloomberg reported today that Turkey's central bank sold and swapped about 60 tons of gold worth more than $8 billion over 2 weeks after the war in Iran began. Now, some of that was sold outright, while most of it was used in swap agreements to secure foreign exchanges in liras. Official sector holders are now using gold as a liquidity tool. It looks like we can start to see signs of that in this price action and this volatility as well on the chart. Pull up your chart for gold. I mean, last time we spoke, you warned us about an ABC correction, noting that you were worried, the market could take that final C wave lower. I mean, with spot gold now trading down in the 43.80s and losing over $120 in the session alone. Is this simply that C wave playing out, and for the bulls watching, I mean, does completing this correction finally clear the deck for a recovery?
At some point, and I believe it could be a week or so before we see it. But absolutely, in terms of that correction I was looking for, the ABC correction, if we move over to the chart, after we hit this all-time record high, and that was back on the 29th of January, we did go into an ABC correction. The A wave took us to 44 and change, and then we had that B wave, which came in just right. The B wave should always be between 50 and 70% of the move down. And this move here, as you can see, the lines are light, but this is our final C wave down. And the interesting thing is the C wave itself, when you look at the action on Monday and you look at the wick on that candle, let me go ahead and blow this up a little bit. What you see is that won't do it.
Everyone wants the correction to be over, but the structure says the market isn't done punishing late buyers yet. As Gary Wagner points out here, this ABC pattern isn't random noise. It's a textbook unwind after a January 29th peak, with a $120 single session drop signaling forced liquidation, not healthy consolidation. The B wave retracement falling neatly within 50 to 70% suggests institutional precision, not retail-driven volatility. What's rarely said is that C waves often overshoot expectations, especially when liquidity tightens. For investors, this isn't a reset, it's a stress test of conviction and positioning. Next, Gary Wagner discusses whether support levels can actually hold under this pressure.
What you see is the wick came down and actually challenged but found support at that 200-day long-term moving average. And so do I believe it's over? I think that we have the ability to retest if support holds at the 200-day moving average. Also, considering these moving averages broke through the 50 simple day moving average, then the 100-day, and now that last banyan of hope, which we've relinquished because obviously we've seen this go down, and you have to take the truth. It's been bearish, and we have a bearish Domino right now. We can talk about the reasons later, but if it does continue to move lower, it's really got to test 4,097, and that's the low that came in on Monday, which matches the 200-day moving average. Now, it recovered quite nicely, even though it closed lower on Monday, went up for a couple of days, and now we have a significant sell-off, down roughly $100, 97 now. So you can see it's moving back up from these lows that came in earlier during the day. Right, so in terms of the technicals and the ABC, that's how I see that playing out. We are in the last part of that C wave, but it could go back to test these lows. It could easily falter. You see these X's here. So roughly at, wow, it's so, I haven't seen gold like this, but at 42.85, if it does come down and test the 200-day moving average, that's at 4,090.
That brief bounce off the 200-day moving average may look reassuring, but the broader damage underneath tells a different story. As Gary Wagner points out here, once price breaks the 50-day and 100-day averages in sequence, the trend has already shifted from accumulation to distribution. A nearly $100 intraday drop followed by weak recovery signals sellers are still in control, not stepping aside. What investors often overlook is that repeated tests of the 200-day typically weaken it, not strengthen it. If 4,090 breaks, it's not support failing, it's sentiment collapsing. Next, Gary Wagner talks about what's really driving this pressure beyond the charts.
We'll have to see how it plays out. Oil has been the big thing. And the other thing that's really spooked traders is that it is perceived now that the Federal Reserve will not cut rates. We knew that during the announcement that was made during the Fed meeting, but now there's a 38% probability, according to the CME's FedWatch tool, which talks to interest rate futures traders, and they've got to be pretty sharp on that, otherwise they wouldn't be trading the interest rates, a 38% probability that they'll actually enact a rate cut later this year.
Yeah. Yeah, no, it's definitely flipped. I mean, the tone certainly has. I mean, of course, we just saw a Brent crude spike past $108 a barrel as optimism for a quick peace resolution starts to fade here. What we're finding out, obviously, it's a developing story, and we're also getting fresh warnings about global inflation. I mean, oil is clearly driving yields higher, but what needs to happen on the charts for gold to decouple from this rate pressure and finally catch a safety bid?
In my belief, the number one thing that would help it fundamentally is if we saw crude light soften in terms of price. It has come back down below 100, but that is what's pressuring the thought of inflation. And because of that, the actions of the Federal Reserve at upcoming Fed meetings with a possibility of a rate hike, and that has challenged price of gold.
The real driver here isn't gold weakness, it's oil rewriting the entire macro narrative in real time. As Gary Wagner points out here, a Brent spike above $108 and a collapse in rate cut expectations to just 38% flips the script from easing to tightening, almost overnight. What's not being said is that gold isn't failing as a safe haven. It's being crowded out by rising yields and inflation fear tied directly to energy markets. When oil dictates Fed policy expectations, gold loses its independence. For investors, this is cross-asset pressure, not isolated weakness. Next, Gary Wagner unravels how yields in oil are cornering gold's upside.
Yeah. Hey, I mean, if oil stays elevated and forces the Fed to remain hawkish, is there, a technical floor that can actually hold, or are we kind of entirely at the mercy of the bond market right now?
Well, Treasury yields have been rising, and what we see when we see that is gold tends to thrive when interest rates are lower, because the investor's looking at what potential investment has the best outcome of profitability, and the treasuries have been the play recently, and the energy, crude light.
I know you have a chart on that, and it feels as though when we pull up an oil chart right now, you can almost see some tweets. You can almost see some of this talking back, peace deal, not peace deal. Is there any technicals making sense in that one right now?
Well, here's what we're looking at. When we look at, I've got a fib retracement starting at 55 and moving up. You see during this day, the high came in at 119, but it didn't close there. It closed roughly at $94. But then we opened up a couple of days later at 100, closed below it. And so it seems as though there is technical resistance, fundamentally based, of course, at $100 a barrel.
Markets aren't reacting to charts anymore. They're reacting to geopolitics disguised as a price action. As Gary Wagner points out here, rising treasury yields are pulling capital away from gold because investors now see bonds as the cleaner, yield-generating trade. What's overlooked is how fragile this setup is. Oil flirting with $100 isn't just resistance. It's a policy trigger that can keep the Fed hawkish longer than expected. That creates a loop where higher yields suppress gold regardless of technical flaws. For portfolios, this means macro forces are overpowering technical signals right now. Next, Gary Wagner discusses how oil volatility continues distorting market behavior.
But over the last 3 days, we had this tremendous move on Monday from about 100, closing at 88, and then we see it really moving back up. And now we've got crude light at about 93.50. Yeah. This is the most active futures contract. So, this is a hardcore parabolic spike over about a week. And then we do see resistance at 100. It has tested it, but it has not been able to sustain that level. But nonetheless, this is hurting globally. Right. Not only Americans, but all around the world, because we are a petroleum-based society, not even a country, but all over the world. And you're seeing the impact on that. And inflation being a major concern because we're a petroleum-based society. Yeah. And so when it spikes, it hurts. The answer to that is to resolve the conflict in Iran with the United States and Israel, because without that, it's going to be difficult when you've got Iran controlling the strait and limiting the amount that comes out of that major throughway, which I believe accounts for about 20% of global production runs through the strait. So we've got to look to see that abate. If that does, we'll see crude oil abate. Until that does, we're going to see pressure on gold, the probability of inflation moving higher.
What looks like a simple oil rally is actually a geopolitical choke point tightening global liquidity. As Gary Wagner points out here, a violent swing from $100 to $88 and back toward $93 in days signals instability, not strength, especially with resistance holding near $100. What's rarely acknowledged is that 20% of global oil flow tied to a single strait creates asymmetric risk. One disruption can ripple through inflation, yields, and currencies instantly. For investors, this isn't just energy volatility, it's systemic pressure feeding directly into portfolio drawdowns and policy tightening. Next, Gary Wagner unravels how this spills over into silver's sharp breakdown.
Yeah, and of course that's pressure on, straight into inflation fears, yields, dollar strength. I want to switch over to silver, Gary, because it's taken a beating. It's down over 5% on the session, testing a low of about $60 or so it's $67 on the spot side. And I know obviously you trade futures, but a drop like that shakes out a lot of weak hands. Looking at the Fibonacci levels and the broader kind of structure, is this starting to look like an oversold buying opportunity, or is the technical damage too deep to kind of step in right now?
Well, the technical damage is major. It is steep. We look at short term, that 50-day moving average broke through that back on March 11th. Then it broke through the 100-day about 4 days ago, and it has tested the 78% fib retracement, not the 200-day. So without a question of a doubt, it has changed. And in terms of momentum, if it's overbought or oversold, but in terms of the stochastics, you can see that it came down to really nothing, and right now it's sitting at about 25.
A 5% drop in a single session isn't just volatility, it's forced exits happening in real time. As Gary Wagner points out here, breaking both the 50-day on March 11th and the 100-day days later confirms a structural shift, not a temporary pullback. What investors often miss is that a stochastic near 25 may signal oversold, But in trending markets, oversold can stay oversold much longer than expected. This isn't bargain territory yet. It's where weak hands get cleared before any real base forms. For portfolios, stepping in too early here can compound losses quickly. Next, Gary Wagner discusses how much further silver could realistically fall.
So it's definitely momentum based on a stochastic technical study showing us that it has become oversold and come back up, but then it's spiked down again. So silver, I believe, has room to go as low as the 200-day moving average. It's tested and found support at the 78 fib retracement, and the data set that I'm using for that starts back in October of last year when we were looking at silver at about 46 up to this incredible all-time record high above 120.
Yeah, what a wild chart to look at. I mean, you and I have been through some trenches together, but when you get hit with some of these macro shocks, it starts to change the narrative a little bit. And this is why I wanted to bring up, Gary. I mean, Bloomberg reported today that Turkey's central bank sold and swapped about 60 tons of gold worth more than $8 billion over 2 weeks after the war in Iran began. Now, some of that was sold outright, while most of it was used in swap agreements to secure foreign exchanges in liras. If official sector holders are now using gold as a liquidity tool, it looks like we can start to see signs of that in this price action, in this volatility as well on the chart.
An oversold bounce means little when the bigger players are quietly selling into strength. As Gary Wagner points out here, silver's path toward the 200-day moving average suggests the trend hasn't stabilized, especially after a parabolic run from 46 to above 120. What's not being openly discussed is the $8 billion gold swap by Turkey. This signals liquidity stress, not confidence, and hints that central banks may prioritize survival over accumulation. When official buyers become sellers, volatility isn't temporary, it's structural. For investors, that changes how you interpret every rally. Next, Gary Wagner unravels whether this could trigger a broader domino effect across markets.
Absolutely. Fundamentally speaking, Turkey is a world power, but a drop in the bucket compared to what could happen if some of the major countries begin to do something. Russia just announced that they are not letting any of their gold go, and they're a huge producer. And that, to me, is significant. But absolutely, that we could see a domino effect. We haven't yet, but I wouldn't count it out. As you said, we've been through the trenches. This one is a deep trench, without a doubt. The resolution is to end the conflict somehow between the U.S. and Iran. If that occurs, we could really see a pivot from bearish to bullish. Until that occurs, I believe that the bearish pressure will remain.
Yeah, wild. Anything that traders should be looking out for over the next week that you just want to kind of grace them with and say, hey, watch these levels, and then we can kind of find out where before we let you go?
I mean, sure. There's no technical aspect to what we've seen in gold, silver, and crude oil. It's all fundamentally based. The main action we need to see is a resolution between the U.S. and Iran. Until that happens, there's nothing out there that will save these commodities from moving lower. It cannot find support when crude oil has spiked so high, so quickly, and has that real potential and already has ticked up inflation. I believe I heard the reading that they're going to announce at around 4% inflation. You know, the Fed target's 2%, so it's double what their target was. At the best, we got it down to, or the Fed got it down to 3%, which is still 1% above their target. Now it's double that. And so that's the concern. The fix to all of this is the military conflict in the Middle East. with the U.S. and Iran. That's the biggest issue. If that gets resolved, we will see the possibility, and I believe a strong probability, of a reversal in gold and silver. As long as that conflict remains headline news and they don't, the peace talks that they're having haven't had favorable results. At least that's what we're hearing. And until that changes, we could see gold meander lower, silver go lower, and crude move higher.
Markets aren't waiting for charts. They're waiting for headlines out of the Middle East to decide direction. As Gary Wagner points out here, when inflation expectations jump toward 4% against a 2% Fed target, it removes any realistic path for near-term easing. What's often left unsaid is that geopolitical risk isn't just volatility. It's a regime shift where fundamentals override technicals entirely. Russia, holding gold while others sell, creates fragmentation in global strategy, not alignment. For investors, this means price action can stay irrational longer than portfolios can tolerate. Next, Gary Wagner discusses what traders should actually watch in this unstable environment.
Yeah. Hey, before we sum up, I mean, we got pretty comfortable there with all this narrative about central bank demand and buying. And it looks like, central banks have continued to be buyers according to the World Gold Council. But with this news out of Turkey, I mean, if central banks start monetizing gold during stress instead of just accumulating it, does that change now how traders should think about support in this market?
Absolutely. We have not seen this in a while where central banks are using gold to boost liquidity and to do things with what Russia did, what Turkey did. These are defensive mechanisms that are in place by the central banks, and they're reacting to the real possibility of inflation getting out of hand. And one thing is that crude oil serves as a very sensitive commodity to inflation because it's across the board. It challenges corporations, companies, individuals. And once that happens where the individual is suffering because of these high prices, I believe in the U.S. that crude has come up by over gasoline, has come up over $1. That's something that's got to be resolved, and it all stems back to the military conflict in play.
Yeah, well said. And I guess on the other side, it could say once these localized liquidity crunches pass, it kind of implies central banks will eventually have to step right back in as a massive physical buyer to replenish those reserves as well.
The biggest shift here isn't price, it's behavior. And that's what markets tend to misread first. As Gary Wagner points out here, central banks using gold for liquidity instead of accumulation marks a rare pivot that signals stress beneath the surface. What's not being openly discussed is how this undermines the central bank put narrative that many investors rely on for long-term confidence. When buyers become temporary sellers, support levels lose meaning and volatility becomes policy-driven. For portfolios, this introduces a new layer of uncertainty tied to global liquidity needs.